Hello, friends. Today I have a very special guest for you. Let me have the pleasure of introducing Mr. Vinod Bhat, uh, a portfolio manager and equity strategist at Aditya Birla Life AMC Limited. And Vinod comes with 2 decades of experience, with 50 years of experience in the financial markets and investment banking space. And he has been associated with Aditya Birla AMC since July 2018. He will be completing 5 years there. And prior to joining Aditya Birla AMC, he was the Vice President Corporate Strategy and Business Development with Aditya Birla Management Corporation Limited. Prior to that, he was also an investment banker at Credit Suisse and Ocean Park Advisors in USA. And Vinod is a CFA, Chartered Financial Analyst, and he has done his MBA in Finance from Wharton School of University of Pennsylvania, USA. And he also holds a MS in Industrial Engineering from Pennsylvania State University, that is also from USA, and BTech in Mechanical Engineering from IIT Mumbai. So great to have you in the show, sir. And today he is going to talk about an interesting topic: why investors should consider active mutual funds over stock investment. Over to you, Mr. Vinod, sir.
Sure. No, thanks a lot for having me on your show. It's my pleasure to be here and share my thoughts with you and your investors.
Yes,
Thanks a lot.
yes, sir. So initially, my first question would be like, I would like to understand about the investment processes carried out by Aditya Birla AMC, by the investment team before drilling down on a stock, and also you can throw light on your risk management framework.
Sure. So at Aditya Birla Sun Life AMC, on the equity side, we are a team of 25 members, out of which we have an analyst team of about 14, right? So each of the analysts covers, one or two sectors, right? And what happens is, the way the process works is, we have an investment universe, okay, of about 450 stocks. And the way it comes about is, see, for every analyst who's covering the sector, they keep track of the companies in that sector. And if they think a company is worth investing, worth looking at, then they do some preliminary research. Okay. So they go meet the company and the management. They talk to, for example, the distributors or retailers, for example, for that company. They talk to some industry experts and they form a view. Okay. And also build a preliminary financial model, right? So after doing that work, we have an internal team discussion. It's an open debate, right? Where the analyst presents that idea along with the financials, and the entire team of analysts and fund managers ask questions, right? And tries to see whether they can, we can build a conviction in that stock, right? So if, for example, we are not satisfied with the business or the management, then that stock doesn't get introduced into the universe. Okay. If we think fine, the business seems fine, management track record is also good, then we introduce that stock into the universe, right? And it's only from our investment universe that the fund managers can then think of investing in that any stock, right? They can't just go and invest in any stock that is listed. Okay. Now, given that a stock comes into the universe, then the next question is it the right time to buy that stock, right? So there the valuation also comes into the picture, right? And so then there are additional discussions, right? So the fund manager might think, okay, now is not the right time, so I will wait, right? At some point, okay, they think this might be the right time, and there is a follow-up discussion with the analysts, right? So again, we look at, for example, the macro conditions. We can look at whether, the sector is positioned properly for the macro environment. How is this company position, valuation? And then if the fund manager thinks that fine, this is a good time to buy the stock, then they start building up a position slowly, right? So they don't build the entire position at once. So they start building the position slowly. If, for example, the stock corrects and we have conviction in the stock, then they add to the position, right? Or else they look at how the trend is going to happen, right? So that's how the process works in terms of how the stock is introduced in the universe by the analysts, how the discussions happen, and how the fund managers buys. And then with the risk management team, we have a separate risk management team of about 12 people, right? So their job is to independently monitor the portfolio of each of the funds, okay? And basically raise any red flags if they see any concerns, right? So what we have done as part of a risk management process, we have defined some bands, okay, for sector weights and stock level weights in each fund, right? So, and those are tied to the benchmark, right? So, for example, we don't want a fund manager saying that, "Oh, I really like the specialty chemical sector, so I'm going to invest 25% of my fund in just that one sector." That will be very high. The risk management
Yeah, concentration is. Yeah.
will not allow that, right? At the same time, if, for example, the specialty chemical sector has a 5% weight in the benchmark, the fund manager can't say that I won't have any exposure to that sector, right? So there is a minimum exposure band also that is there. So we have a minimum and a maximum band, right? So for sector as well as stock. And the risk management team independently monitors that, and if they see any red flags, then we have a monthly meeting with them, and the fund manager has to take action. So that's how risk management comes into the picture. And in terms of the regular monitoring and action, right, the way we work is every Tuesday morning we have a meeting for our fund managers where they talk about the fund, like which stocks they have, which are performing well, if you're not performing well, what portfolio actions they are thinking of taking, how is the fund position for the macro environment, right? And they're asked questions by the other fund managers as well as by our CRO, and they have to answer and take action. And every fortnight, we have a meeting with all the analysts where they talk about their sectors and stocks. So there's a regular monitoring that happens, feedback process is there, and action has to be taken. So this is how, in general, the investment and risk management process works.
Yeah, very well. And as you know, sometimes the growth stocks will do well, sometimes the value will do well. So it is a combination of that, because the rally will not be uniform, because the equity is always a non-linear asset class. So
Exactly.
those type of monitoring makes a big difference. Yes, sir. My second question is that can you would have noticed that the 37% of the demat account opened during that COVID 2021 has actually become inoperative, and the so-called Robin Hood investors who have started their journey directly into equity stocks, currently they are not at all visible at all. So, what is the lesson to be learned by the so-called Robin Hood investors, or any investor who does not have a financial background but wanted to experience investment instead of choosing mutual funds if he has directly invested in stock? And what is the lesson to be learned, and can you throw some light on?
Yes. So that's a very interesting question, because even in my extended family, relatives, friends, I have seen this happening, right? Right. Folks have opened demat accounts and they started trading. So one of my relatives told me that he invests directly in stocks, but he does not analyze the financials. If he likes the story of the stock, he invests. Then another person I know, his wife, she's a housewife, she's at home, but she took some online classes and she started trading stocks and started doing FNO trading also, right? So all these apps, why was network also so, and like you correctly said, all of this really kind of took off during COVID, because most of the people were at home, and this was one of
A lot of time.
yeah, and this gave them some excitement, right? But what has happened now, like we all know, for the past year and a half, our stock markets haven't really gone anywhere. They've been flat almost. Right?
Yes.
So the returns are not there. And what we have seen, even over the long term, is retail investors are unfortunately governed by this greed and fear mindset, right?
Yes.
So when the markets were rallying and doing well, that greed was there. So everybody thought that it's very easy to make money investing in stocks directly or doing FNO trading. So everybody wanted to try that. Right? And over the past year and a half, people have lost money or they have not made money. They realize that it's not as easy as it seems, right? So now they have stopped, and they are trying to find out something better to do, right? And it's not just with stocks and I mean, I know people who used to trade crypto also. I'm sure you would also know, right? And all of them are,
In fact, the crypto percentage has been much higher than the entire MF penetration in India.
yes, exactly.
And now that the government circular has come to say that that is considered as illegal.
Yeah, exactly, right? Yeah, so all of these things are happening, and now people have realized that nothing is as easy as it seems. Many of them are sitting on losses. I personally know a couple of youngsters who came to me and asked me now, like, that they're sitting on losses, so what they should do, right? And I always tell everyone, see, if you want to do investment directly, there are three prerequisites, right? You should have the time, the interest, and the capability, right? If either one of them is not there, then it's better you just invest in mutual funds, right? So most of us are doing our jobs, or somebody's managing their own business. They will not be able to devote the time needed to analyze stocks, right? Because I know, because we are in the fund management industry, it's a 24/7 full-time job.
Correct. Correct.
So it's not possible. If you think I'm not going to analyze the financials, I'm just going to invest in a stock, that's not going to work in the long term, right? So if you don't have the time, better to invest in mutual funds. If you don't have the knowledge and the capability, again, just easier to invest in mutual funds. And many people are not really interested. Like, they just see people around them doing it, so they try and they realize it's not for us. So again, it's simpler to just invest in mutual funds. So just a brief message is, keep your life simple. Do what you really like to do. Focus on your core competency and leave the investing to the professionals.
Exactly. Very well said. And as you know, we've been listening to all the fund managers, and we always inculcate the discipline of asset allocation also. So with the right fund management and with the right risk profile, we'll keep doing it. And how important it is for the investor to have the right financial consultant or the advisor or the MFT to onboard them in the financial journey. We can do right on that.
Sure. So, I've actually recently published a book called The Financial Independence Marathon. It's been released by Penguin in Jan. And this is what exactly I highlighted, that to be successful, in investing. And if you think, okay, I want to reach a stage where I'm financially independent, there are 3 steps. Okay. One is having the right mindset, right? So it is not like running a short-term sprint like Usain Bolt, right? Actually, think of it like running a long marathon, right? So we have to be prepared for it, right? We need to have, so that is the first thing, like, it's a long-term journey. You have to be patient. It's not something that just a few months you can make the return. So that is having the right mindset. Second is having the basic knowledge of different asset classes. So whether it's, for example, traditional ones like FD, gold, real estate, or stocks and bonds, and equity mutual funds, fixed income mutual funds, hybrid mutual funds, or even stocks or FNO, you should have a knowledge of the asset classes. But then you should always focus on the principle of asset allocation and risk before return, right? So what I mean is that don't jump into something just looking at the, where I can get the maximum returns. First think, is there a risk of losing my money, right? So that is the first question. Think of risk before return. And the best way to reduce risk is to diversify. That's what the principle of asset allocation is, right? So have a diversified portfolio of equity mutual funds, fixed income mutual funds, some hybrid funds, right? And then if you want some direct stocks, if you want, right? But have a diversified portfolio. Now, the third part, of course, is managing emotions. And that's where most retail investors fail, right? So either we have FOMO, like fear of missing out, where if the market is rallying, we want to put our money in, right? Or if the market corrects, we panic and we want to stop our investments or exit, right? And that's where the role of the MFD or the financial advisor becomes paramount. Because just like a coach, like for example, I am into running. I've been running marathons for the past 13 years. And I know the difference, the value of the coach in the training, in the guidance that they provide. The same thing in investing, right? The MFD or the financial advisor guides us. He helps us maintain our cool during crucial periods in the market. Right? So if the market is correcting, like in what happened during COVID, instead of panicking and exiting, advisors would have said, just hold on and invest more money, right? Because the market will recover. So that's the importance of the financial advisor, the MFD, in the life of an investor.
Yes, very well put across. I will definitely go through your book. And coming to your portfolio, as you have international equity, plan A and plan B, where plan A is completely into international equity and plan B 70% into international equity and 25% into domestic. What is the rationale behind it? Having 2 different funds in international equity, can you just give us and how important that international equity funds also need to be a part of the investor's portfolio? Because finally, if you look at that, gives a dollar-denominated return apart from the international equity return.
Yes. So exactly. So and this is the second part. First, in terms of diversification, we always recommend at least have exposure to domestic equity, international equity, fixed income, and gold in the portfolio. Of course, many people have real estate separately, right? So international equity is an important component of the portfolio, and we recommend that at least between 5 to 15% of the equity should be international equity, right, of the equity allocation. So that's point number one. And in terms of the difference between international plan A and plan B, see, as per SEBI regulations, any international fund is taxed like a debt fund. Okay.
Yes.
So the plan A invests 100% in international stocks is taxed like a debt fund, right? Whereas plan B has 65% allocation to domestic equity and up to 35% allocation to international. Right? So hence it's taxed like a equity fund. So that is the difference. So it's just that whatever the portfolio of plan A, the international stocks, they are exactly replicated in plan B also. So that is the difference between the two funds, right? So if somebody, for example, already has a portfolio of domestic funds and they want international exposure, they can just invest in plan A for the international diversification. If somebody wants a combined exposure, domestic plus international, they can look at plan C.
Plan B. Yes. Definitely, sir. And it's been great listening to you with all the great things. Would you like to give a summary of the session on why people should consider equity mutual funds? Because in spite of mutual funds, I hear campaign by Amphi and Fleet on Street and lot of communications, still the percentage, if you look at 175 lakh crore is in FD and 4.5 lakh or 40 lakh crore is the entire mutual fund AUM. Of course, SIP is doing well, but still, what do you think? How investors can become financially independent and how they can beat the inflation adjusting return and generate and be financially independent in their events by planning an equity of your final comments?
Sure. So the point I'd like to leave investors with is don't think short term. It's not a 100-meter sprint. You are not Usain Bolt. Okay. You are running a marathon. It's going to be long term. Be patient, right? And that's where, doing these short term things like investing directly in stocks or crypto, it's not going to work, right? And we have seen it, right? Just over the past 3 years, many people have lost money and now, they don't know what to do, right? So rather than that, think you have to run a marathon. So the best way to do it is through mutual funds. Have your MF or advisor to help you. Just stay with the right mindset, right? So like I mentioned, the right mindset, basic knowledge, and managing your emotions with the help of your advisor or this is the way to go, right? And that's what I've explained in my book, Financial Independence Marathon. So definitely take a look at it. It will help you in your journey.
Thank you very much, sir, for being in the show, and we look forward to listening to you on a different topic in the months to come.
Sure. Yeah. Thanks for having
it. Thanks, sir. Yeah, thank you very much.
Bye. Bye.